I think in recent years, we have seen a variety of other plays that maybe are not traditional activism, but they're activists in effect, in the sense that they shake things up, they often put the company in play, generates a tremendous amount of press. And by this I mean very aggressive short sellers. So they're obviously short the stock, they're not long the stock, so they're not the activists, but they create by very, very aggressive and accusatory, often frivolous and false, but there they are, short seller reports that drive down the price of the stock, put a lot of pressure on the company.
Joining me today is Yoel Kranz, partner and co-chair of REITs and real estate M&A with Goodwin. Yoel, thank you so much for joining us today.
Pleasure to be here, thank you.
Now, I'd like to start by talking about activist actions. What sort of actions are you seeing in the REIT industry?
Activist activity in the REIT industry has really morphed and changed over the years. So it used to be that activists were not active in our sector at all. That changed probably about 10 years ago, some pretty prominent. Those were traditional activist plays, which is an activist accumulates either on or off the record, either directly or by derivatives, 1%, 2%, 3%, 5%, 6% maybe, but you can't go above the REIT ownership limit that are built into the charters. And then with that small toehold, they do what activists do, which is you demand change and you publish letters, or sometimes you start privately usually, you have a meeting with the CEO that you demand to present to the board, then you ratchet it up, and then it goes public, then you demand seats on the board, then maybe you fight a proxy battle, all those sorts of things. I think in recent years, we have seen a variety of other plays that maybe are not traditional activism, but they're activists in effect, in the sense that they shake things up, they often put the company in play, generates a tremendous amount of press. And by this I mean very aggressive short sellers. So they're obviously short the stock, they're not long the stock, so they're not the activists, but they create by very, very aggressive and accusatory, often frivolous and false, but there they are, short seller reports that drive down the price of the stock, put a lot of pressure on the company. You see that, you see plain old hostile takeover. That's the way, it's not activist per se, but certainly puts the company in play. So there are a variety of ways that so-called activism can become prominent and sort of have an effect on the trajectory of a company.
And how do you advise your clients to prepare for possible activist engagement?
Yeah, I said earlier today, the key is readiness, but it's very hard to get people ready when they don't know what's coming, or if they don't believe it's coming. And so you only really learn and prepare when you're under the threat of actual pressure, fire, whatever the right euphemism is. But there are a variety of ways that you can be ready, right? So you have to have you need to have a PR strategy. Not everybody talks to whoever picks up the phone or sends you an email. There's got to be, there's a PR strategy. There's a one person. There's a board contact. Everything gets coordinated. You have to have how to look in the mirror. How is your stock performing? Is it a discount or a premium to NAV? How is your corporate governance? Are you listening to your shareholders? What are your votes coming in? Are you getting voted up or down by ISS or by Green Street? None of these things are dispositive. God knows we at Goodwin don't agree with ISS or Green Street or anyone who sort of thinks that you could quantify corporate governance in a number. But you have to know where your vulnerabilities are. You have to know what it is you're going to say. And you have to have a better answer for the strategic direction of the company than whatever the activists are saying. Right? That's how you prepare.
And lastly, do you think that current REIT valuations could lead to more activist deal environment this year, or go the other way, less activity?
We've been talking about this for a long time. During the pandemic and right after the pandemic, valuations fell. You thought, all the bargain buyers are coming, but they didn't come. I mean, some did, but largely they didn't. And then when the market turned again and you see this deep discount to NAV, at least perceived NAV, again, the buyers didn't show. So it's not clear exactly what stimulates or doesn't stimulate the buying. It's not, valuation obviously is key. Nobody makes a bid for a company unless they think it's accretive, unless they think it will be accretive. Obviously buyers and sellers don't always have the same view of value, but they have to meet somewhere where both parties think they're getting a good deal. That's not happening in this current environment, other than it's very select. So in the markets where, if you're in the, I don't know, call it a strip center market, right? Those assets are fairly valued right now. At least the REITs are pretty fairly valued. If you're in the healthcare sector, those assets are trading at a premium. We do see M&A in these sectors. Either, it may not be whole company M&A, sometimes it is. Last year we had whole company M&A. You see portfolio M&A, you see non-traded REIT. In sectors where the NAV is off a little bit, either on the high side or on the low side, people aren't really ready. Sellers aren't ready to rip off the Band-Aid, and buyers aren't ready to commit when they're not certain what the future is. So it's not, somebody said earlier today, M&A is not only about the math. There are many non-math things that go into M&A, and we're certainly seeing that.